coming up on Retiring Well with Michael Reese.
That is not the only number that you're paying, that there are other expenses that you pay that are completely hidden, that are significant, and you need to take them into account when you're investing your money. I want to go find properties right here in town and buy those properties, and I want to fund that using my IRA. Now, I got to tell you something. I don't like hearing that in a lot of cases, because the first thing I think is, I heard a lot about that in 2007, right before markets crashed. And now that I'm starting to hear it again, that's not making me real comfortable about what are going to happen in markets. I think history is starting to repeat itself a little bit here.
Now, the host of Retiring Well, Michael Reese.
Welcome to the show today. We have 30 minutes of action-packed information specifically designed for you. Retiring Well starts right here, right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
This week in CFP Talk, we're talking about mutual funds and the fees that you pay when you invest in mutual funds. Now, as you know, millions of Americans put their money in mutual funds, and hey, you might be one of them. The question that you want to ask yourself whenever you invest your hard-earned dollars in mutual funds is you want to know, what are you paying them to manage your money? And not, what are all the fees? Not just the ones that you see. Are there other fees that you don't see? Well, that's what we want to talk about today. So in a recent study regarding mutual funds, the average fee, the average expense ratio of a mutual fund here in the United States is about 0.90%. So what does that mean? Let's say that you are looking at ABC Mutual Fund or XYZ Mutual Fund, and you open up the prospectus. The prospectus is that document that they give you before you invest, and you want to do your due diligence. So you open that prospectus up and you read it, and it says right there in the prospectus, oh look, your expense ratio, the amount that you pay the advisor every single year is 0.9%. Now, you're never going to see that anywhere other than the prospectus. You won't see it on a statement or anywhere else, but it's there in the prospectus. And so you think to yourself, well, that's not so bad. That's less than 1%. And as a certified financial planner, I would tell you, if you're paying less than 1% on your investments, that's a reasonable rate. I would give you an A grade on that. But here's the problem, and here's what this study taught us. And this study, by the way, came out in 2011, so we're talking like 5 years now. They taught us that that is not the only number that you're paying, that there are other expenses that you pay that are completely hidden, that are significant, and you need to take them into account when you're investing your money. So here's what the study told us. This was a study that was written about in Forbes, written about in Barron's, I think Investors Business Daily, all the big publications talked about this when it came out in 2011. So here's what they said. The first thing you have to watch out for are these things called transaction costs. So transaction costs. What are transaction costs? That is what a mutual fund pays to buy and sell the different positions. And there are a number of transaction costs. There are the cost, the actual cost that the mutual fund company pays to buy and to sell. There is a spread, which is the difference between what they're buying or what they're paying versus what the other side is buying or selling for. There are things like when a mutual fund, a big mutual fund sells shares, they might sell 1 million shares in any company at any one time. And when they do that, that affects the markets negatively, and so you end up getting less of a return. But if you add all these murky transaction costs up, on average, 1.44%. That's what you're paying each and every year on average. Some years more, some years less. We're talking about the average fund. And obviously, some funds are going to cost more, some are going to cost less. This is just average. The next level of cost you got to watch out for is something called cash drag. What the heck is that? Well, whenever you invest in a mutual fund, there's always a certain percentage of your money that's just sitting there in cash. But you're paying your fees on the whole thing, And so on average, that costs 0.83% when all the numbers are crunched. Now add all this up, 0.9, 144, 0.83. 3.19% per year is what you're typically paying in the average fund. And we're missing two things. Loads / advisory fees, and in after-tax accounts, taxes. Folks, this mutual fund you think costs less than 1% could end up costing 4% a year when all of this is said and done. Know your costs. Now, if you have any questions about this, or anything that we talked about here, please feel free to give us a call. We are happy to help you out.
Since 2000, we have seen the market drop to half its value a couple of times. We are now in the second largest bull run of all time. Is the bear poised to strike again? Many are speculating that it is, but we are not going to take that position. The truth is, no one can predict when because they always come unexpected. The key is being positioned to handle it no matter what happens.
By objective, a mutual fund will hold the securities it said that they would hold in the prospectus. For example, a large cap mutual fund is going to hold large company stocks. If the market crashes like it did in 2008, then what does that large cap mutual fund do? Think about it. Will they go to cash?
You will be hard-pressed to find a large cap mutual fund that did not go right down with the market. Don't be caught being passively invested like that. What you want is active management. You want someone managing the downside as well as the upside. Also, don't get caught in the buy and hold trap. You have to remember that in 2008, when the market crashed, it started in December of 2007 and ended in March of 2009. Think about it. That was a 15-month period. Every month, people were getting their statements and they would ask their advisor what they should do.
And what was the mantra? Just hold. It always comes back. Sure it did, almost 4 years after it hit its bottom. We think that is unacceptable. It is also critical to understand what you are paying in fees. It continues to amaze us how little people understand what they are paying.
There are only two ways to grow a portfolio. One is by the interest and dividends being earned by the underlying securities, or what we call yield. And two, by appreciation, the idea that a security will grow in value. If I'm trying to grow to get a 6 or 7% return, and I'm only getting 2% in yield, and I'm paying fees of more than that, then my whole portfolio is relying on speculation. That's where you get volatility. We have all been taught you can't have great reward without taking great risk. It is not true. You can achieve market-like returns without volatility.
We have the tools today to show you how much risk you are taking. We have the tools today to show you how much you are paying in fees. Don't you think you have the right to know? To the first 10 callers, we will perform a risk and fee analysis for you absolutely free. If you had a life-threatening illness and the doctor was prescribing a critical procedure, well, wouldn't you find it appropriate to get a second opinion? You have saved retirement your whole life. Don't you think your life savings deserves a second opinion as well? Again, for the first 10 callers, we will do the risk and fee analysis and we'll show you how to avoid being just passively invested. Give us a call.
All right, this week in our segment of Ask Banks, we actually have a question that came in from one of the viewers here. And it's from, I remember her name was Sherry. She was asking the following question. She was saying, hey, Banks, hey, Banks. Yeah, well, Banks pays attention to Sherry about as well as me, as you can see. Anyway, Sherry was asking the question. She said that she'd been watching the show, and on this show we talk about converting to Roth IRA because we love Roth IRAs. They're tax-free, right, Banks? Tax-free, we love that. Oh yeah, those are good things. And we talk about you want to convert or have a plan to convert IRAs to Roth IRAs if it makes sense for your planning. So Sherry wrote in. She said and you can, if you have a question, you can ask Banks. I think it's askbanks at retiringwell.com, I believe. Anyway, she asked a question. She said, "Hey Banks, she's in a 401k now," and she said, "I'm in a 401k." And she was watching the show about converting to Roth IRAs. She's still working. Can she convert her 401k to a Roth IRA even though she's still working? And that's a really good question. Banks, what do you think about that? You want to answer Sherry for us? Banks looks like she's doing about the same thing she normally does, which is just lays around and looks good. Okay, good. Banks. So anyway, when it comes to, oh my gosh, look at this. What a ham. When it comes to your 401k, Sherry, here is something kind of interesting. If your 401k has a Roth option, so some 401ks, in fact, a lot of 401ks have the ability to have a Roth option inside of your account. If your 401k, if your company provides one that has that Roth option, you can, right, Banks? I know you're excited about this. You can convert within your 401k the dollars that are any portion or the whole amount, dollars that are in the traditional account, you can convert to the Roth side. Now, you will pay tax, of course, in the amount that you convert. So if you have, $100,000 that you convert, you're going to pay tax on $100,000 of income. So remember that. Now, one thing that is different with Roth conversions inside of a 401k is that a Roth conversion inside of a 401k, you cannot change your mind. So with a regular IRA, if you go IRA to Roth IRA, you have a period of time where you can change your mind and go back, but not inside of the 401k structure. You make that change in the 401k, it is done. You cannot change your mind after that. So it's irrevocable is the term. Now the other thing you can think about, Sherry, is you said you're still working. If this is the 401k that you're at a job you're at, your options may be limited. What you might need to do, if you're over the age of 59 and a half, you might be able to do an in-service rollover, and that just means you can take money, even though you're still working, from your 401k and move it over to your IRA. And wow, that's cool. Now, poor Banks, I've lost her here. But anyway, you can go from 401k to IRA, and when that happens, you can then do the typical Roth conversion process. But what if you're still working, you're under the age of 59 and a half? See, I don't know your circumstances, but if you are too young, then you're kind of stuck. You kind of have to wait until you either A, get a new job and move away from that company, or B, hit the age of 59 and a half. Now, you didn't say this, but if that 401k is, say, from an old job or something where you don't work there anymore, well, then it's easy. Then you just go from 401k to IRA, and off you go. You can do all kinds of cool stuff there. Unfortunately, I didn't have a quick answer, and Banks didn't have a quick answer for you. But what it comes down to is simply this. If you can do something, that's great. I always encourage you, talk to a professional before you take any action. Talk to someone. Look, call our office, Sherry. Well, we're happy to sit down with you and help you analyze what you're doing there to make sure you're making smart choices. And, folks, for all of you watching the show, if you have questions about Roth conversions and 401ks and IRAs, I want you to call us. Give us a call. We are here to answer your questions.
You've worked hard for your money and your best is yet to come. You've reached a point where you don't put your money at risk anymore. The road ahead doesn't scare you because your money is secure and working for you. Centennial Wealth Advisory, portfolio stability, tax reduction strategies, lifetime income, financial security in any economy.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Thursday, November 17th at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com to reserve your seats today. There's no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
You know, just the other day, I had someone come into the office, just like you. They're watching the show. They called us. They came in the office, and they had some questions about their IRA. And what they wanted to do was the following. They were saying, hey, I want to buy real estate in my IRA. Now, I don't want to buy like a real estate investment trust or something that's regularly traded. I want to go find properties right here in town and buy those properties, and I want to fund that using my IRA. Now, I got to tell you something. I don't like hearing that in a lot of cases because the first thing I think is, you know, I heard a lot about that in 2007 right before markets crashed. And now that I'm starting to hear it again, that's not making me real comfortable about what are going to happen in markets. I think history is starting to repeat itself a little bit here. But what did I tell him? Well, what I did is I looked at him and I said, Frank, you can do that. It is certainly legal to do that. But, you know, like my dad said, just because you can do something, it doesn't mean you should do something. So I want to share with you 3 reasons. So I told him, I said, Frank, I'm going to give you 3 reasons why I wouldn't recommend that. I want to give you the same 3 reasons. Okay, this is really important. So if you're thinking about this, please pay attention. Reason number 1. The first reason that you don't want to buy real estate in your IRA is really simple. You lose all the tax benefits. I mean, if you think about it, owning real estate as an investment, especially when you own the real estate directly, you get all these wonderful tax benefits, depreciation, and you get to write off expenses and all that cool stuff. But in an IRA, everything's taxed at ordinary income rates. Yeah, you get tax deferral, but when the money comes out and all the gains, let's say you're successful, let's say it works, and you make a bunch of money, you get to pay ordinary income on all those gains. If you were investing in it outside of your IRA, on the other hand, not only would you pay capital gains, long-term capital gains taxes at the worst, which is a lot better rate, you can also do things like 1031 exchanges, avoid taxes altogether. In an IRA, you can't do that. All right, reason number 2. The second reason you don't want to do this, Frank, and to you, self-dealing rules with IRAs can get you into a ton of trouble really fast. So there's a great example in case law where there was a fella, he did this. He used his IRA to buy rental real estate. And one of his places needed, now listen to this, this is ridiculous, needed new paint. He had to freshen up the paint for a new renter. And so he just went to the store, he bought some paint and painted the walls so his new renter could come move in. Not a big deal, right? Oh, except for the IRS when they audited them said, no, that's self-dealing. You can't do that. You cannot, if you're going to do anything with an IRA, you can't do it yourself. You got to go hire someone and do fair market value and all that kind of jazz. Very, very complicated and very, very easy to violate. And you know what happens when you self-deal in an IRA? It's all cashed out. It's considered as though you cashed it all out, all in 1 year. You pay taxes on the entire amount in 1 year. This poor guy had to pay tax on over $1 million of an IRA distribution all in 1 year. Horrible. And then finally, number 3, required minimum distributions. Once you hit the age of 70 and a half, you're forced to pull a certain amount of money out of that IRA each year. There have been situations where people they take their IRA, they buy real estate, there's not enough cash in there to distribute for required minimum distributions. If you don't have enough cash to distribute for required minimum distributions, that is a 50% penalty on that distribution on top of the income tax that you pay. Typically 75–80% of the money goes to the IRS. Nasty. You want to avoid that. So there you go. 3 reasons you don't want to use your IRA to invest in real estate. 1, you lose all the tax benefits. 2, self-dealing challenges. And 3, required minimum distribution problems. Folks, use your IRAs for different things. Use after-tax money for real estate. You'll be much happier in the long run. If you have questions about this or anything else we talk about in the show, by all means, pick up the phone, give us a call. We would love to answer your questions.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation?
Will you be there for my ball games?
Will you teach me your values? Will you be able to play with me?
Oh, help me go to college. How will I remember you?
Have the retirement you dream about. Contact us today.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Thursday, November 17th at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com to reserve your seats today. There's no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
Welcome to Coffee Talk. My name's John Torbett, and I'm here with my colleagues Larry Flynn and Art Canfield. And we get a number of common questions as we're in meetings throughout the week, and so we thought we'd just open those up and share a few with you.
John, here's one we'll hear occasionally.
Sure.
I keep hearing the term in-service rollover in regards to my 401k. What does that mean?
Sure. So in service, basically saying, okay, you're still working for your employer, but you have a 401k plan. So this in-service rollover idea is the fact that your 401k, you actually have the ability to roll that over to your own traditional IRA and ultimately start planning for retirement within that IRA, because the 401k, one of the big disadvantages that people find is that within the 401k, your options or your investment options are typically pretty limited. So people like to sort of have control over their retirement planning, and so within that IRA, now it opens it up to multiple investment options for them.
Isn't it funny how many times clients come in and they have their 401k and they don't know that they can do that.
Right.
They can actually roll it out into their own IRA account.
Yeah. It always amazes me how people don't have any idea what's even in their 401k, and they've just been saving for all these years, and they're just kind of blind to what's even in there, what's it about. Often I think, when we're talking with these in-service rollovers, we're encouraging them to talk to their employers, look at their summary plan descriptions to see what options are even available for them if they can do that.
Yeah, and it seems like there's a trend going on right now where a lot of the employers almost don't want that liability of having the 401k anymore, so they're sort of opening it up for this in-service rollover where, hey, you're still working, but if you want to leave the 401k plan, feel free, because we don't want to be liable if like another 2008 occurs and you lose a lot of your money. We want you to be ultimately responsible for that.
It's kind of important to note that, because this is a lot of times what the clients will think, but just because they roll out into their own IRA, it doesn't mean that they can't still participate in the 401k, right?
Right. Still, usually if you're still working, you would want to keep participating. You don't want to give up that ability, especially if there's matching.
Right, exactly. Well, good.
Well, one of the other questions, guys, it seems like we get all the time is, hey, I'm retiring at the end of this year, and I'm fortunate enough to have Roth IRA money and traditional IRA money. Should I draw from my Roth IRA first so I don't have to pay any taxes?
Oh man, guys, as soon as I hear that question, I think of that person that came in. They had asked their advisor 10, 15 years ago, right, which account I should pull from, and the advisor said, well, pull from your Roth account because you're not going to have to pay any taxes. And then for the next 10, 15 years, while they were in the low tax bracket, they could have been pulling out of their IRA. So here they're dwindling down their Roth IRA account while their IRA account was growing. I mean, just terrible advice, terrible advice.
Right. It's really something, ultimately, we recommend each year you got to look at your tax situation and sort of see where's that income going to fall. Can you take advantage of the existing tax code to basically either draw from traditional IRA, or if maybe you need to draw a little bit from the Roth IRA, but it doesn't seem to make sense to pull it all and pay no taxes when you could have pulled potentially from a taxable IRA and paid little to no taxes.
Yeah, that's
so
right.
It just seems from like a mindset perspective, people are so excited they've been paying taxes all these years, and they get into retirement and they see this tax-free account. Hey, I don't want to pay taxes anymore.
Right.
But they have to, like you said, John, they got to look at this every year because it may or may not make sense.
Right.
Yeah, there's a real sweet spot we find is when clients stop working and before they take Social Security, right? If there's a few years there that they're in that low bracket and they don't have that Social Security income and that's a great time to maybe be taking more out of the IRAs, right? Or possibly converting it to a Roth.
Mm-hmm. Well, good. Well, we appreciate you tuning in, and thanks for joining us for Coffee Talk. We look forward to talking with you a little bit more on the next episode.
Thanks everyone for watching the show today. Now, if you have any questions, feel free to call our office or visit our website. And remember, you only retire once, so let's get it right the first time. We'll see you next week.